In a diversified portfolio, investors look to bonds for cash flow and as a safer option than other investments. A bond is an investor's loan to a company or government to fund initiatives. Over time, the investor receives interest payments and then, at maturity, receives their principal back. However, in a low-yield environment, fixed-income investors may struggle to meet these goals. Pacer ETFs created the Pacer Trendpilot U.S. Bond ETF, or PTBD, aiming to address these needs. PTBD uses a rules-based trend-following strategy to determine exposure between the S&P U.S. High Yield Corporate Bond Index with the goal of generating yield, and the S&P U.S. Treasury Bond 7 to 10-year Index with the goal of providing risk management. How does it work? PTBD changes market exposure based on 3 indicators. For example, picture a traffic light. When high-yield bonds are trending up relative to treasuries, PTBD is given the green light to participate in the market with 100% exposure to high-yield corporate bonds. When high yield is in a downtrend compared to treasuries, PTBD is given the yellow yield signal and will scale back with 50% exposure to high-yield bonds and 50% to treasury bonds. If high yield continues in a market downtrend, the fund is given a red stop signal. PTBD will prevent further declines by moving 100% to treasury bonds. When high yields become more attractive relative to treasuries, the portfolio will return to 100% high yield. To learn more about PTBD, visit paceretfs.com or contact your financial advisor. An investment in the funds is subject to investment risk, including the possible loss of principal. Pacer ETF shares may be bought and sold on an exchange through a brokerage account. Brokerage commissions and ETF expenses will reduce investment returns. There can be no assurance that an active trading market for ETF shares will be developed or maintained. The risks associated with these funds are detailed in the prospectus and could include factors such as calculation methodology risk, ETF risks, fixed income risk, government obligations risk, high yield risk, limited operating history risk, management risk, passive investment risk, tracking risk, trend lag risk, and other special risks of exchange-traded funds.